Episode 570, Trading Justice Podcast. Inflation gaslighting. We're going to discuss how some powers that be are gaslighting you. Inflationary data came out this week. Fed's meeting this week. Bunch of salespeople, they're up to something. Probably not good. I think that's Gold and Bitcoin been telling you that for a minute, right? They've been telling you that for a minute. But we'll talk about that. We're going to break down the market or speculate on how wussy Jay Powell is going to be this week. Because if you think he's coming out with a backbone, I've heard a lot of speculation. Jay Powell's going to come out tough this week. Yeah, we'll see. I don't like that side of the bet, but how you doing, brother? How you doing?
Doing good. Doing good. Excited to be here for another edition of the pod. And as always, if you love the pod, give us a nice little like and share on YouTube, and give us a nice little iTunes review if you're listening to it on a podcast near you. We always love the support from our community. There's no doubt about that. And but overall, I am excited to be here for another edition of the pod, Mark. I feel like we're going through an important moment from a monetary perspective. I know we talked about quantitative easing last week and the impact on inflation. Well, we're starting to see early signs of double dip inflation. And so I think it's important for us to get an understanding of exactly what the inflationary situation is. And we're going to talk a little bit about 1970s inflation here today. And I'm going to talk a little bit about understanding the timeline of inflation in the 1970s in comparison to what we're going through now. And I find it rather compelling. So
yeah, I don't want to bury the lead here. When you and I spend a lot of time in pre-production and what message do we want to deliver and that, and your primary, most important message for this podcast is?
It's simply understanding that the inflationary situation we are going through right now is concerning, and the data suggests that we are experiencing a little bit of double dip inflation. And despite the fact that we've had 2 consecutive months of CPI increases, despite the fact that the PPI report is on the rise, despite the fact that we've had oil break out, despite the fact that in the inflationary report just this previous week, both energy as well as shelter, which are 2 of the largest components of the inflationary situation, you're hearing a lot of Fed officials talk about how interest rates are going to be coming down, inflation's on the path to recovery. And quite frankly, I've heard these song and dance from the Fed officials before. And quite frankly, I think certain Fed officials, Goolsbee being one of them, but I also think Janet Yellen and some of the powers that be are trying to manipulate not the data necessarily in the inflationary report, but they're trying to manipulate how we see the current inflationary environment, because they are trying to discount some of the bad data that is coming at us over the last couple months. And I think we need to be aware of it. And I think we need to be fully apprised of what is happening out there so that we can make better decisions and not trust the powers that be on the inflationary situation. Because here's the reality, Mark. They don't have a good track record
They have a freaking terrible track record.
To the market.
Here, Janet Yellen apologized this week, Matt, saying, yeah, I regret using transitory. Yeah, I mean, some people it was laughably bad, her apology. It was like, well, people interpret that to mean immediately. Well, look, it did eventually come. I'd like to point out a fact, Janet Yellen, who is an absolute politician. She does not have your best interest at heart. You started using transitory, and inflation is higher than when you started using the phrase still today.
Mission is not accomplished yet, and they're trying to pull a George Bush here on the aircraft carrier. Mission accomplished. It's simply not in the data.
Just because you want something doesn't mean.
I could care less what anybody thinks or has to say about anybody else. There is so much nonsense in the inflationary conversation. There's so much misdirection. There's so much opinion. What I care about is the data, and the data is concerning, and that's what we're going to talk about.
Yeah, we will break that down. All right, Matt,
Yeah.
About a month ago on the podcast, you and I both started calling for a period of consolidation. You and I have been very, very good on our big picture calls on this podcast. The big picture calls, like going back a long time now, I like clear back to the October lows in 2022. We have made some really good calls, and you and I have called
I
for
was ducking, dodging all those bears back then. There's no doubt about that.
and you and I both called for consolidation to occur, and that's pretty much what has happened over the last month. When you look at the S&P 500, you don't have a lot of price movement. When you look at the NASDAQ, that's just downright textbook consolidation type behavior. What went into your heading to a period of consolidation call, and where are you today with the reasons for that?
Well, there's a couple reasons, Mark. And number one, I mean, I don't want to go through all the litany of reasons why I felt like we were tapping out from a directional perspective. And again, talking about the broad market more than anything. But number one was the general overextended nature of the marketplace. That's always going to be an extremely important one for me. I anchor quite a bit against a technical tool called potential average yield. I look at it when it comes to how far an area of the market can run. So from a yield perspective, when you're looking at just kind of the upward movement in prices here, I'm looking at a weekly chart. So if you're listening, that's kind of what I'm describing. But when you look at the upward movements in price over the course of the recovery from not the entire recovery from pandemic, but just this parabolic move in the market we've seen since the end of October of last year, when the Fed started signaling that they were in fact officially pivoting and that they were going to be looking at cutting interest rates. That's kind of when we started dealing with this V-shape, the latest V-shaped recovery. Well, you start looking at it from a yield perspective. Yield is how far something can run before it gets tired, and you expect it to go into some degree of consolidation. Well, from November to December, kind of in that first leg in the market, you ran from about 4,150 up to about 4,800. Well, that's about a 650 point movement to the top side here, Mark. Well, when you consolidated, and again, you consolidated for about a 4 or 5 week period between the mid-December and really kind of mid-January before you saw it break out again. And that ran from about 4,700 to about 5,200, right around 500 points right now. And so I fully expected slowing momentum because the parabolic nature of the November move was just something you could not expect. To kind of rinse and repeat that. That was a momentum condition. You certainly expected to continue the momentum, but not at the same veracity, because as things go up, it gets harder to push the price. You need more and more and more and more. It's like a drug addict, Mark. You get a little bit, you need more drugs and more drugs and more drugs. Well, the drug here is money. You need more money and more money and more money. Well, that's hard to see without some degree of consolidation. That's hard to see without some degree of development. And so I think the first thing, just kind of going off the top of my head, is just you were in a general overextended environment going in from the daily chart to the weekly chart. And you're going to call for a secondary pattern when you're in solely from a technical perspective. Then when you take that into conjunction with the general overvalued nature of the market, remember, the valuation component takes into account price and earnings. And although everybody else is describing the current earnings environment,
I have to give you credit on this one, Matt. I consume a lot of financial news, a lot of everything. And Matt, if you took their cumulative take on this earnings season, their sales pitch would be, it was a fantastic earnings season. This stock market rally is totally justified because of how awesome earnings was. And you were there every week in earnings season saying,
That's not true, because that's not a true statement. It has improved. Yes, 100% it has improved. But when you look at the price of the market from earnings season to today, the the market's up. Price is up. Well, also is valuation. Price is going up more than the E component of earnings. So you can the market is a tricky beast oftentimes, because you're going to be able to make an argument for whatever you want in the market. It doesn't mean it's an accurate one. It doesn't mean anything, quite frankly. But you can make an argument, but the simple reality is you got to have data to support your argument if you're going to see anything of a consistency play out. And when you're talking about, oh, this earnings season is great, no, it wasn't. It was okay. It was okay. The price response was great. And I kind of feel like that's what they're describing as the great component is the price component of valuation. But when you actually look at valuation, you can't just say a stock went up and that's great. No, you got to look at the E component of that, and that's the EPS. And when you started earnings season, we started earnings season right around an 18 PE ratio in the broad market. You ended earnings season above a 20 PE ratio, which is above both the 5-year and the 10-year average. So price was going up quite amazingly, but the earnings component was not. And the argument I was making was, well, guys, yeah, price is going up a lot more than the E is. E is positive. The earnings backdrop is a positive backdrop, but it is not supportive of the current price that is happening. And so I kind of saw it as kind of a little bit of froth that was playing out. And so we were in general an overextended environment. You couple that with an overvaluation component. And then when you look at the Mag 7, and Mag 7 is separated from itself, you look at technology is starting to show a little bit of bumps in the road. You look at the Russell 2000, the Russell 2000 still in broad-based general consolidation underneath that 2100. So obviously an improving condition, but in general, Mark, I thought it was a little bit of an easy call to say, hey, overextended from a technical perspective, overvalued from a fundamental perspective. Markets look really, really good going into the rest of the year. Obviously, the Fed's looking to loosen monetary strings here. I'm not trying to call for a recession here. I'm not trying to call for, a massive downward movement in price. But I do have concern about the market continuing to move up in the face of some of the data that we are seeing. And so I did feel it was an easy call to go through some degree of general consolidation. And even though the S&P continues to fade up, despite when we said that, I would say in general, when you're looking at everything in the market, we were far more right on this one than we were wrong. You've in general have seen a little bit of consolidation.
Yeah, and will you give me the SPY? Like, I know for those individuals watching this on YouTube, because the S&P had a contract rollover, I think the price action on the SPY gives a better indication of we're about where we were a month ago. Yeah, we're about where we were a month ago, and I think some of those headwinds, some of those things we're facing. And Matt, history for me, like when I look at history, after gigantic rallies like this, you go back at most of the gigantic rallies, and you know what you have? You have consolidation for several months, right? So, I mean, I don't want you to. You said
here is bad. If you want to create a consistent market over time, you got to have periods of consolidation. You got to have periods of downward movement in price, and oftentimes that's kind of where we're at on from a chart and a fundamental perspective. So I don't think those things are bad things. Some of the best years in the market have time periods of consolidation and pullback analysis.
Yeah, and I don't want you to dismiss how you say it was an easy call. It is not an easy call in a parabolic uptrend to say that we might take a cooling off period. That is a hard emotional call.
Let me say it differently then. It should be an easy call if you're not trying to sell stock.
Yeah, okay, fair enough.
Yeah.
Well, which we're not trying to sell.
Yeah, not stock.
Nope. Now if I still had my Lucid shares, I'd try to sell those to you. But I don't have those anymore. So all right, Matt. So we're coming off inflationary week, and we're heading in to Fed week, right? That's where we are in the the drama. Let's talk about, as a backdrop, the actual data that came out last week.
Yeah, it's sneakily a fairly big couple weeks of economic data coming into the market last, just to kind of give you a summary of the last couple weeks of economic data here. Starting with last week, we had labor market last week, which was a really big week economically. This previous week, you had the inflationary week with the CPI report, the PPI report that came out last week. Obviously, we're going to be talking a little bit about inflation here in the second half of the podcast. So I'm going to save a little bit of that conversation for then. But in terms of the CPI report, this is now the second consecutive month we've had bumps up in inflation. When you're looking at the inflationary situation, the biggest concern is the very, very sticky 3% number that it does not seem like we can get underneath that. And for the people that, again, I'll talk about this here in a little bit, but there's an old conversation in the market that I have a lot, and it's called the principle of polarity, that an old resistance level can act as a new support level from a historical perspective. And if you don't have to go too far to understand that argument. We made that argument on gold for about 3 consecutive months late last year going into the 2K breakout. And that was that, is this now a higher threshold of support? Think about the gold argument, Mark. From a macro perspective, the gold argument is if you create sustainability above 2K, 2K is the historical floor, correct?
Yeah, well, and we were really the only one making that argument, Matt. Like, to be honest with you, I did not hear that argument ever, and it was a basic argument for us. It was like,
you listen to a lot more other people than I do. I don't know what other people are arguing out there, honestly. I just give my analysis.
That analysis was the best analysis because that's exactly what happened. It earned it, right? It stayed above 2,000. It had never done that before, and for several months, it earned it, right? It's like it built trust.
Again, now think about that from an interest rate perspective, inflationary perspective, because the principle of polarity doesn't just play out in one asset class. It's based on behavioral analysis. Technical analysis, at the very, very heart of technical analysis, lives a whole dose of behavioral analysis, because the technicals follow the behaviors follow the technicals. But in terms of the principle of polarity, Mark, and I'll talk about this later on as well, but when you basically break out of a resistance and you come back down and you reassess that old resistance as a new support level, that does matter historically, Mark. And when you're looking at the top shelf of the annual inflationary pressure in between like 2017, 18, 19, and 20, that was right around 2.5 to 3%.
Now, I'm going to make sure you don't go too deep here because you're going to be talking about this stuff in depth here in a minute.
I'm going to do this again, but now you're starting to see that get a little bit sticky there around that exact same number. That's got to be concerning, and it really does confuse me why the Fed doesn't talk more about this. Because they focus a lot on the path we've had in the last year from 9% to 3%. What they don't focus on a lot is describing that environment as you basically wiped out the upward movements in price, but you haven't came back down to the historical averages.
And they don't spend any time talking about if we loosen policy here, what might happen.
Well, Mark, what have I said for 6 months on this? Where do I believe the actual inflationary target is?
2.5%.
It's 2.5%. That's what I believe. I believe that the actual target is 2.5%, not 2%. And the data suggests that that's accurate, or the Fed would be a little bit more vigilant, quite frankly. And so it was a big week from an inflationary perspective. I'll talk more about that in terms of the gaslighting conversation in a little bit. Also concerning last week was the PPI report that gave a little bit more concern for pipeline inflation. That's basically doubled in the last month from 0.8% to 1.6%. Retail sales was a mix. Empire State Manufacturing was a miss. In general, last week, I would describe the economic landscape as a concerning week, both due to the mixed retail sales, but it was really from an inflationary perspective. And again, we'll talk about that here in just 1 second. Now, this week is all about the Fed. It's all about the Fed. We get the Fed on Wednesday. Everything's going to be Fed all week long. Fed Day is not a day, it's an event. That event goes from Wednesday till Friday. And so a lot of what we're going to be talking about in the feature on gaslighting inflation, we're going to be discussing kind of how that impacts the Fed. So I'll save that conversation for a little bit as well.
Now let's talk commodities, and then we'll get into precious metals. Let's talk cyclical commodities. Interesting stat: crude oil is having a better year than the Nasdaq to this point. Cocoa is
I think that's going to improve in the next 2 weeks.
Cocoa is better than Nvidia this year.
Mm-hmm. It's up like 500%. It's ridiculous.
Copper had a big, massive, gigantic breakout. Silver, froggy, gold frog. Matt, the market's consolidating, commodities are not. Commodities are starting, to show some pep in the step.
Almost like the Fed is loosening monetary policy and commodities are reacting to that.
Yeah, no, and I don't know if you included it in your presentation, but I showed you a chart of commodity PPI since the Fed pivot in December. Commodity PPI is on a linear line up. Right, we're starting to see this in broad areas. Right, we've had the Bitcoin massive breakout. We've shown gold take a step up, holding levels. We're now starting to see other cyclical commodities show some light. We could give complex analysis, or is it just a function of loosening financial conditions and things are starting to pick up?
Well, I think you got to take it one by one. Crude's going to be a different conversation than gold, obviously, and rightly so. Crude's going to be a different conversation than silver, and so on and so forth. So I do think you got to take it one by one. But in general, yes, Mark, I do believe one of the reasons we're seeing commodities kind of wake up over the last month or so is and not just the recent breakout in crude oil, is because of the loosening of monetary restrictions. Mark, we'll talk about the loosening of monetary policy when we talk about inflation here in just a moment. But yes, I would say in general that is the case. Now, specifically on crude oil this week, you did have a couple news items that came out that kind of propelled crude to break out, and this breakout has to be discussed because we're talking about a pretty decent breakout on crude oil that could see some price appreciation here. First and foremost, Saudi Arabia and OPEC in general restated their commitment to the voluntary price cuts. That's number one. Number two, the United States reported this week their first drawdown in oil supplies for the past 6 weeks. Number three,
not just crude oil, but in like gas, all products
too, in gas too, across the board, oil, gas, you name it. Number three, you had the IEA increase global demand for crude oil in general. So in the last week, you had those three events that really kind of propelled the breakout in crude oil. And what's going to be interesting over the course of the next week or so is, does this get supported? Does this breakout stay a breakout? Or are we right back talking about fake out analysis, which has been kind of a problem child in the market in recent, is breakout, fake out, breakout, fake out. So I don't want to say that's not that's a likelihood, because I don't believe it is, but that has been a pattern in the market. Simple reality is, Mark, you're dealing with a breakout on positive catalyst for crude oil with financial restrictions loosening to the point where you are now as loose from a month. This is amazing to me, Mark. Financial restrictions right now are as loose as they were before they started raising rates. We have a 5.25% interest rate.
And yet, Matt, this is part of the gaslighting conversation, because when you hear Fed officials speak, they're out there and they'll tell you conditions are tight. Conditions are tight. And that is factually inaccurate, and yet that's what they keep saying. What are they trying to sell us, man?
Financial conditions are not tight right now. They're as loose as they were before. They are as loose right now as when they were trying to say transitory, Mark. That's a problem. And I heard it all last week. Oh no, we're in restrictive territory. We are in restrictive territory, but the interest rate is only one component of that conversation. We also talked last week in this very podcast about how they're starting to embrace a little bit of QE chatter. Guess what we've seen in the last week? More QE chatter. In fact, one Fed official was talking about permanent QE, for crying out loud. So no, financial restrictions are getting a little bit more loose. Janet Yellen is part of that. But in general, I don't want to just sit here and complain about financial restrictions getting loose. I want to talk about the why crude oil, silver, copper, cocoa, and natural gas, gasoline futures, why commodities across the board are starting to show not only upward moves in price, they're starting to show downright momentum environments, Mark. And so, yeah, you can try to downplay you can handle, believe me, the inflationary conversation is one you can paint however you want to paint it. You can paint it as an improving condition, a deteriorating condition. It's like if your favorite sports team has won 10 games in a row, but in the last 3 weeks they lost 3 games, Mark. Do you want to focus on the last three games, or do you want to focus on the last 13 games? That's kind of the inflationary conversation. Wherever you start your timeline, you can describe that environment however you want. But in terms of the loosening of monetary policy, that's a data-driven argument. That's not an emotional-driven argument. Inflation oftentimes becomes an emotional-driven argument. And when they're talking about loosening, not loosening financial restrictions, that's just an outright lie. And you don't have to be a rocket scientist. You don't have to be the advanced fundamental analyst. All you have to do is look at these charts, all starting to go up, all starting to attach a little bit of momentum. Crude oil has a recent breakout. Silver's downright momentum, trying to fight back up into the 52-week high. Like you said on gasoline futures
should scare
in the last month and a half.
There's
a trickle down impact on the economy across the board. And so, yeah, and don't get me wrong, we're big commodity guys at Tackle Trading. We do enjoy some commodity analysis. But Mark, I'm seeing the situations where, the Fed might be able to discount gasoline today by saying, well, 9 months ago it was higher. You're right. You're right. But it's also up 30% in the last 3 months. Okay, so we got to be concerned about that. Crude oil recent breakout, you can be like, oh, well, oil was up a little bit more 6 months ago. You're right. But where's crude oil going into the future? You got to be looking at gasoline just from a charting perspective right now. You look at gasoline, you got to be thinking higher. You look at crude oil, you got to be thinking higher. When you look at silver right now, you got to be thinking higher.
When you look at copper right now,
technical perspective.
Yeah, Matt, and this all has inflationary impacts, and we're going to talk about JPAL here in a second.
Because we're talking about the one-to-one impact on the input in inflation. We're talking about the raw cost of the commodity, which you can't discount. So,
do these charts concern the Fed this week at all? Before we get into
if they don't, they are lying and lying and lying some more. They have to be concerned about the froth in the market. Number one, they have to be concerned about the last 2 months of CPI data. They have to be concerned about the PPI report. They have to be concerned about 3% sticky inflation for 6 consecutive months. And they absolutely have to be concerned about rising commodity prices and how that's going to impact everything they're trying to accomplish downstream. And so, Mark, I think the Fed's got a lot to be concerned about this week, whereas in previous editions, they didn't.
Now, it will be interesting if they actually do or say anything this week other than their blah, 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 blah.
If they give us the same arguments that they were doing last month and month before that, they're going to lose a lot of credibility, Mark, because it's not just us that are seeing this. Mm-hmm. This is concerning data. And we'll talk about the historical impact here in just a moment, but you're in a moment where history will remember what happens in this meeting, in the next meeting, in the meeting after that, throughout the rest of this year. History is watching. History is watching, and the Fed is the target. Jay Powell, your legacy is on the line in the next 6 months, not the previous 6 months. The transitory language was damaging enough. That alone puts Jay Powell's legacy at risk. But if he gets this one wrong and the double dip inflation persist, he'll be remembered as one of the, if not the worst Fed official in the history of the United States.
Yeah, I mean,
he needs, and he knows that. He knows that. So we'll see if he wants to get it right.
We'll see if he's actually in charge of anything or if he is just a messenger boy in the coming weeks and months. It's going to be interesting. We're going to talk a lot more about the Fed, but I want to talk about gold just real quick. Because I don't want to lump our precious gold into everything else. I want to just always spend a minute. Matt, I don't know if you have that quote available from the unnamed central banker this week, because that's the only sales pitch I need for gold. And I'm not selling you mine. I'm just telling you.
I would say, which quote do you want?
There'll be demons out there or something like that.
You want that quote. Okay.
Oh, it's a fantastic quote. Here. It is one for the ages.
Here it is. Well, you wanted it. Are you going to say something about it?
Dude, I will read it. The old world is dying, and the new world struggles to be born. Now is the time of monsters. And he might as well said, buy some freaking gold. Right freaking now.
It's a good ad for gold.
It is a good ad for gold.
It is. An unnamed official at a Bank of America.
An unnamed Fed official, correct?
Not Fed official. We don't know that.
We don't know that for
central bank official. We don't
central
know
bank official.
Yeah, we don't know if it was a European central bank. All we know is that it happened at a Bank of America conference this past week, and an unnamed central bank official. It could have been from the U.S. It could have been from Europe. It could have been from Japan. But this does sound like a European quote.
It does sound like a European quote. Right?
If I had to guess, I would say it came from the Europeans, but it could come from anywhere. But that's just speculation.
That's a pretty good bet, though.
The old world is dying and the new world struggles to be born. Now is the time of monsters. That quote is an amazing quote.
Holy cow, it's so good.
But what he or she was referring to is something you and I have talked about a lot in this podcast, and it's the end of the United States dollar being the dominant reserve currency in the world. And that's the quote he or she used to describe the current environment as we're going through the evolution of currency of the reserve currency. I could talk about the evolution of the reserve currency every week in this podcast, every single week in this podcast for the next 5 years. And I do not believe I would treat it with that much time. I don't think would be treating it with the respect it deserves. It's that important of a conversation. I agree with whoever said this. We are going through a massive evolutionary period. I've described it as the end of fiat currency in general. I've described it as the end of the third phase of the entire currency cycle that dates back to the 9th century AD. This is, and to hear it from central bank officials, and not just people like me who try to read the tea leaves, it's happening out there. And what he or she was describing was in the world of monsters being all these other currencies trying to, replace the vacuum that the dollar would create if we ended up losing reserve status. Now, it is not a guarantee that we end up losing reserve status. The future has yet to be written on that. But there's also a lot of things that America needs to do to maintain reserve status that they are not currently doing. I felt it was an amazing quote. I felt it was an accurate quote. I felt it 100% described the macro environment from a currency perspective. And you know me, Mark, I love these creative type quotes that tie a historical situation into a current moment in time. And that's what occurred here. But at the end of the day, the old world is dying and the new world struggles to be born. In every single environment, and this is the only thing I'll say about gold, in every single environment from a currency perspective that I can think of, historically speaking, where I could describe that current environment in a similar way.
Changing dynamics.
It was gold that maintained. It was gold that lasted. It was gold that was there in the beginning. It's gold that is here today. It will be gold that's here in the end. It doesn't mean there's not room for competitors to the inflationary protection of gold and the currency protection of gold. Bitcoin has a wonderful and strong argument for that. That's why I describe Bitcoin and gold analysis as same team, guys. Same team. We're both fighting the central bank, and there's plenty of room in the fight against the $15 trillion behemoth of the central bank. There is plenty of room for gold and Bitcoin analysis there. So I just felt that was it was an amazing quote, Mark. There's no doubt about that. It was an amazing quote. It will be talked about for a while, I would say. Regarding gold analysis, last week, Mark, we generally described it as an overextended environment. I talked about the need for patterns to develop here. We're getting those patterns. We're getting those patterns. And when you're looking at gold analysis right now, I think you got to look in conjunction with the dollar. And basically, when the dollar starts forming a retracement, gold's going to form the opposite retracement. That's what we're seeing play out on the dollar this past week. Dollar showing a little bit of a bearish retracement. Simultaneously, what are we seeing in gold? A little bit of a bullish pullback. GDX, I called for consolidation around 30 last week. That's exactly what we're getting, consolidation around that very, very important number around 30. And so I do think gold is in a much better situation this week going into next week as we were talking this same time last week. But we still got to come to the proper conclusion in reversal in retracement analysis. And right now we're just kind of tracking a flag. There's nothing wrong here. Gold looks absolutely amazing. It's sticking the landing. I haven't seen any issue with the gold analysis, and we're just tracking this next pattern.
Yeah, great analysis there. Great analysis there. Like we could go on. I'm gonna have to force a stop so we can talk about some gaslighting, some historic inflation. Matt, this has so many important topics. You've used the word history a couple times, right? And you specifically were like, this is a big historical moment, this meeting and in the coming meetings for the Fed, right? You are not one for hyperbole. You are not one for hyperbole. And so like you don't like it. You don't like it when I do it, I am prone to hyperbole. You don't like it. And so when you say those type of things, there's a reason. And I think this presentation, these points that you're going to talk about for a few minutes here, highlight why you say that it's so important.
Well, and it's not necessarily a presentation. I just put some slides together just to kind of visualize some of my concern here. And certainly looking forward to a conversation more than a presentation here. But inflation gaslighting, you and I were talking about this yesterday, and we were just having a conversation on inflation and central bank quotes from recent history. And I kind of feel like the central bank's getting this one wrong. When you have inflation historically on the path to recover, you don't stop. You don't stop. You got to stomp that into the dirt. You got to bring that to a proper conclusion, because if you take your foot off the gas in your fight against inflation and inflation creeps around, it's like the evil villain in a horror movie, Mark. If you don't double tap it, it's coming back, and it's coming back worse than what you felt it was the first time. And so I kind of feel like we're going through one of those moments in time where we could look back historically, similar to how we look back in 1975, 1976, 1977, and say the Fed got it wrong. And I kind of feel like the Fed, the current edition of the Fed, is repeating some of the same mistakes that was there in the 1970s for everybody to see. And so we're naming the podcast Inflation Gaslighting because we're seeing concerning inflationary data over the last 2 months. We're seeing sticky inflationary data over the last 6 months. We have crude oil, cyclical commodities breaking out, showing bullish momentum. And yet what we're also seeing is the Fed, at least from a language perspective, basically declaring victory against inflation here. And I just feel like that
totally
is
clear,
really, really, really bad mistake. And I feel like they are putting a tremendous amount of negative impact on so many people that never see this happening and never see this coming down the road. Goolsbee made a quote last week where he said, "It's totally clear that inflation is coming down." Is it, Goolsbee? Is it totally clear? Is the argument finalized that we are mission accomplished on the inflationary fight, and you can start loosening monetary restrictions because we're just back into the good old times of 1% inflation? We don't need to worry about it. And I saw 3 or 4 quotes like this in the past couple weeks of just prematurely declaring victory against inflation. And Mark, up until last month, I felt
Matt, just ask, the Fed has kind of had this for months, this mission accomplished vibe, right?
Well, yes, they have. It's really been the case since probably last November when they declared victory against inflation and why the market started going parabolic. So this conversation of mission accomplished on inflation has really kind of been one, and mission accomplished is not inflation is gone, is the Fed doesn't have to fight it any longer. You allow the economy just to kind of cook on its own. You don't want to have a restrictive and you don't want to have a supportive monetary perspective. That's the battle the Fed is waging, because the Fed doesn't ever want to kill inflation. They literally target 2% inflation on a year in, year out basis. But we've seen in recent history multiple examples of Fed officials coming out and basically declaring victory on the inflationary fight. And I just feel like this is absolutely insane to me after so historically wrong on the transitory language in the first place. And so I wanted to just talk about whether or not it is absolutely totally clear that inflation is coming down. Because again, it kind of depends, Goolsbee, where you're pointing your starting point versus your ending point on that conversation. If I wanted to look at, for example, the last 2 months of inflation, I wouldn't say they're coming down. I would say inflation's starting to go back up. If you look at the last 10 months of data, inflation is coming down. If you look at the last 3 years of data, we're basically flatlining on inflation. And so it depends on what you're discussing coming down. And I would also like Goolsbee to tell me, are you talking about post-pandemic inflation targeting, or are you talking about pre-pandemic inflationary targeting? And so I think it's not as easy as just saying, hey, it's totally clear, everything's good out there. And so, yeah, I said it's gaslighting because, quite frankly, I see Goolsbee's quote as a form of gaslighting, and I see what Janet Yellen is doing from an inflationary perspective is a massive form of gaslighting. So what is gaslighting, Mark? Gaslighting is a form of manipulation where someone tries to make another person doubt their own reality, memories, or perceptions. On inflation, nothing to see here, guys. Goolsbee, everything looks good out there. Janet Yellen, we're on a path to 2%. Everything's good out there. Jay Powell, you know what? We still got a road to go down, but you know what? We feel like we can loosen monetary restrictions. And again, I want to be very, very clear on something. 2 months ago, I was on that path. Based on the data you were seeing as of right then, you can remove the restrictive territory. Now, my commentary was made specifically on the interest rate perspective, and that was before they started doing all their other versions of artificially manipulating the interest rate in terms of loosening monetary restrictions. And so in terms of basically right now, I do not believe the Fed should cut interest rates based on the last 2 months of data. Now, what is double dip inflation? Double dip inflation is the concern that I feel we have right now. We haven't experienced a lot of historical examples of double dip inflation. But what it generally is exactly how it's described. It is a non-sustained price stabilization between two high inflationary phases. And so think about two market cycles here. Market cycle goes up, inflation goes up, Fed raises interest rates, inflation comes down, Fed cuts interest rates, inflation goes up. That's basically the market cycle. You can look at it as a business cycle, inflationary cycle, however you want to describe it. Inflationary pressure goes up and it's cyclical like that. There's a pattern to it. Well, with the double dip inflation, what occurs is you never get the inflation in the correction territory of the market cycle to actually give up anything, which means when inflation starts to creep its, ugly little head again, you start from a higher point on the inflationary scale. So for example, Mark, if you go up 4% in inflation, but you start at 0 and you end up 4, right? Well, if you get all that back down to 0 and you go up another 4, you're right back at 4. It creates this cycle between 0 and 4. Well, if you go from 0 to 4, but you start that cycle again at 2, what you create is a bullish uptrend of higher highs and higher lows is what you create. The double dip inflation is a higher level of support when it comes to that inflationary conversation. Keep that in mind when you start thinking about double dip inflation. And typically why we get double dip inflation is it's really based on one thing. The Fed is too premature in loosening monetary policy. That is why you will get a double dip inflation. And again, I say it all the time. You got to put that last nail into the coffin when it comes to inflation. You got to double tap inflation. You cannot allow inflation to rear its ugly little head because it does not just go away on its own. You got to force inflation out of the conversation. And there's only a couple ways to do that, Mark, and they both result in a little bit of pain. But that's one of the biggest problems with this conversation is nobody's willing to go through any degree of pain because we all want to have greatness every single day of our lives. But in terms of the double dip inflation, I want to describe the 1970s, for example, here, Chucky. Now, in the 1970s, and I'm going to try to make this simple, okay? In the 1970s, which I do believe is a proper case study with what we're going through today. The 1970s starts, and the inflationary saga in the 1970s starts with the end of the Bretton Woods Agreement of 1971. That leads to an oil crisis by 1973. Inflation starts to go up, up, and up, and up. By 1974, you're dealing with about 12% inflationary annual rate. The white line is the inflationary rate throughout the 1970s. Now, in 1975, you start to see two things take hold to combat the inflation. Number one, you started to see interest rates go up to combat the inflation. That's 1 + 1 = 2. That goes back since 1913 when the central bank was created. The second thing that typically does occur when you raise interest rates to combat inflation is you go through an economic recession, which basically cancels out all demand and it drops price down, 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 down. In 1975, 1976, going into 1977, that's exactly what you have play out. You have basically inflation coming down based on increasing interest rates and an economic recession. But before that came to a proper conclusion, you know what happened? They started cutting interest rates. With inflation at an annual rate over 6%, they started cutting interest rates. That led to commodity prices going up. As commodity prices went up, you had another oil embargo due to it that saw commodity prices skyrocketing. That led to Paul Volcker getting nominated as head of the central bank in 1978. In 1979, Paul Volcker decides to aggressively raise rates because he said, I am not going to deal with this at all. We are going to stomp inflation into the dirt. That's why Paul Volcker is seen by many people, including myself, as the best central bank president of all time, because he had the courage of his conviction in a moment of crisis where inflation was just ripping people apart. The economy was terrible. Geopolitical situations were happening across the board. We're in the middle of a terrible Cold War. We just got out of the Vietnam War. We went through 2 bouts of inflation in the 1970s. And Paul Volcker says, you know what? America is struggling, but they are never going to not struggle if we don't cure the underlying problem. And the underlying problem is not recession, it is inflation. And so we will deal with some economic pain over the next couple of years as we cure the inflation. Okay. Paul Volcker does that, and we have basically inflation's wiped out by 1983, and all of a sudden by 1983, you're back down to 2.5% annualized rate. All right, that's the 1970s, the quick version of the 1970s timeline. When you look at it from an annualized CPI report, Mark, I basically plotted the annualized CPI numbers from 1972 to 1982 here to kind of show you from a trending perspective what I'm talking about. So when you're looking at 1972, for example, in 1972, the annualized inflationary rate was 3.3%. By 1973, that had climbed to 6.2%. By 74, that number was 11%. By 75, as you started raising interest rates, as you started going through an economic recession, that brings the annualized interest rate down to 9.1%. As that takes hold, by 1976, that number comes down to 5.7%. At this point, you're on the path to recovery. At this point, everything looks good. At this point, you can even give yourself a golf clap saying, you know what? Good job.
It's clear that inflation is coming down.
Coming down. Everything's good.
You can say that.
Okay. Everything's good. It's coming down. But you got to kill inflation. You don't stop at a higher threshold because that puts an increased support in there. You don't want to see that. You want to see that inflation come back down to where before it started going back up. And what happens? The Fed declares victory way too soon here, way too soon, because of the economic pain that was happening to the people. The Fed starts loosening monetary policy, first through the interest rate. There's other measures that take place. All of a sudden, the economy starts to, get a little bit better, but so does inflation. Inflation goes up in 1977, goes up in 1978. And then all of a sudden, you have a commodity breakout again. Oil embargo sets through in 1978. Oil prices go through the roof. Gasoline prices go through the roof. All of a sudden, inflation's getting out of control again. And Paul Volcker comes in and says, enough is enough. We're going to do it right. In 1980, the annualized inflation rate hit a peak of 13.5%. Paul Volcker ripped up the game plan, raised interest rates aggressively, and over the next 3 years, inflation went back down to that 2.5%. So, what was the big mistake that was made in the 70s? It's impossible to plan the geopolitical situations, Mark. They're going to happen. We have to navigate them. The problem was when a moment where they were on the path, they declared victory too soon. The data that we're seeing right now, when you look at the saga of the 1970s in comparison to where we're at today, if you were to ask me, Matt, where are we at today in this saga? We're right here. We're on the path But now we've had a couple consecutive months of data that is concerning. You have the trend now going in the wrong direction. And the Fed, very similar to 1976, when they started loosening monetary policy through the cutting of interest rates, very similar today. You're not seeing the cutting of interest rates, but there's more tools that the Fed has today than they did in 1976. You're starting to loosen up the monetary policy by declaring victory too premature. And that is my general point. If you see yourself as being right here, you can't stop this journey until inflation's gone. You can't. You're putting way too much risk on the American consumer. You're putting way too much risk on the American dollar. You're putting untold risk on the reserve currency conversation. I can tell you that. You got to stop this into the dirt, quite frankly, and they are not doing it in any capacity. And so when you look at the current situation, Mark, and you take into account, okay, total financial conditions. When we were going through 9% interest rates or year-over-year inflation, the financial restrictions were relatively high. But now that we're seeing a bump up in inflation over the last 2 months, now we're seeing commodities break out and run. Well, how is that going to fix if the financial restrictions right now are equal to that of what they were before we went through the bouts of inflation post-pandemic in the first place? There's nothing the Fed is doing right now to stop this conversation. There's nothing that's happening right now to stop the double dip inflationary situation. And so for me, when I'm coming back to where the Fed is, if this is where you believe we are in the 1970 saga of inflation, is we're on a path to recovery, but we're not there yet. Well, you need to see Jay Powell act like Paul Volcker and say, we will deal with some economic pain. And I don't even think he has to make that argument. I think Jay Powell can just say, listen, we're going to give up some of the economic benefits we've gotten over the last year or so with this loosening of monetary environment, and we're going to stop inflation into the dirt. I doubt that's what's going to happen. But if you're looking at that as the situation, and that's kind of how I see it, is we are right here, 1976, on a path to recovery, the inflationary situation. But you got to be vigilant. And the Fed is not being vigilant right now. In fact, they're being the opposite of that. And where the gaslighting is taken into place here, Mark, is they sit there in their meetings, they sit there in their speeches, they sit there in their policy statements, and they say, we are vigilant because of solely where the interest rate conversation is. Well, we're vigilant because we're in restrictive territory. We're vigilant because the interest rate is in restrictive territory. You're right. But why are you also embracing quantitative easing? And why are also the monetary restrictions now equate to what we were dealing with during the pandemic? This is absolutely insanity to me that you have loosened financial restrictions this much in the last 6 months with all the data suggesting that we have kind of found a really, really sticky point on the inflationary.
And yet, Matt, Jay Powell, his opening sentence in his meeting on Wednesday will be, we are very aware of the hardships that inflation caused among the American people. He'll say that because you know what? Because he's gaslighting you.
And yet, once again, and they're not going to raise rates this week. They're not going to raise rates. To me, there is a 0 chance probability they're going to raise rates this week.
You mean cut rates?
Excuse me, cut rates this week. I honestly think they might.
You did a Freudian. They should be. Yeah,
I did a little bit, but they're not going to cut. They're not going to cut this week. They're just not. But Mark, he is going to talk about the American consumer. He's going to talk about representing the American consumer. He's going to talk about the path to 2% and being on the path to 2%. One chart, after everything I just discussed, here's where we're at on the year-over-year CPI front. This was the old shelf. Let me get a line chart here instead of a bar chart. That's the old shelf. When you're looking at this inflationary conversation, once again, if there's one thing you understand, you do not stop your fight against inflation until you can declare victory with confidence. And based on the last 2 months of CPI increases, PPI increases, in conjunction with both a commodity breakout as well as the loosening of monetary environment in general, that's what we currently have in the last 2 months. We haven't won this battle yet. The only thing that has occurred here on the inflationary front is you've given up the gains in inflation post-pandemic. But this cannot be the ending point. It can't. If this is the ending point on the inflationary saga, we will go through a double dip inflation, and double dip inflation. If you think the inflation was bad in 21 through 23, double dip inflation will feel 10 times as worse.
Yeah, and it's interesting to see just on the historical how strong that second wave can be, right? Like, how strong it can be. And so, like I said, you're not prone to hyperbole. You laid out a succinct reason. We got a Fed meeting, Matt. I saw some individuals speculate that, oh, Jay Powell's going to come out hard.
He should.
That's not the he should. Right. And maybe they're projecting what he should do.
I know people aren't going to like this. They're not going to like what I'm about to say. But if you want this situation resolved, be vigilant against inflation, talk tough against interest rates, but allow the market to correct 10%. That will alleviate a lot of this concern. I'm not sure Jay Powell wants to see that occur. But again, I look at the principle of polarity. It plays out all the time. And if the Fed is not vigilant right now against inflation and they accept a 3% number, which means I will be accurate on the soft target of 2.5%, this can't be the ending point of the saga. If this is the ending point of the saga, we are signing up for double dip inflation. And if you sign up for double dip inflation, it's not guaranteed to occur, but a double dip inflationary situation and the monetary environment that would create a double dip inflationary situation would result in the end of the reserve status for the United States dollar within the next 10 years.
Yeah. But Gillsme, tell me again how everything's just peachy keen. Right? We live in the age of monsters.
Again, like you can paint inflation however you want to paint inflation. The concern is the double dip concern of inflation, and the Fed needs to treat it with a tremendous amount of respect. And that respect was not paid out in 1976 or 1978. That respect was paid out in 1979 when Paul Volcker jacked up the interest rate 10% and said, we're going to park it there until inflation's gone. And you know what resulted? Some pretty nasty economic years, but about, I don't know, 18 years of stabilization.
Yeah.
I don't know. I think I could sign up for a little bit of choppy neutrality over the next couple of years if that fosters in a better environment for the future.
Yeah. Well said. Well said. Let's see what he does. Meeting. He's got a couple speeches this week. He's got one on Friday. Obviously going to talk after. It's going to be interesting to see what the Fed dot plots say, right? Do they price in any additional big week?
I have to think that the Fed knows this conversation.
They're not obtuse about it.
Which means to me, Mark, if they're embracing, which is not even a debate, like they are fully embracing loosening monetary policy right now.
Yes, they are.
They're literally talking about permanent QE right now in an environment where we should do the polar opposite of that. So, like, if that's the case, yeah, soft target 3%, not even 2.5%. That's and again, when you're thinking about the difference between 2% and 2.5% target and 2% and 3% Fed target, I don't know how other ways to describe it other than this. The difference in this conversation is whether or not you retire in 40 years from now. The difference in this conversation is whether you're working for your entire life. The difference in this conversation is whether or not you can save for a rainy day, put money away for your kids' education, take care of your family, provide health care. Like, the difference in this conversation of 2% to 3% inflation is the difference between a middle class and no middle class. It's the difference between the haves and the have-nots. I mean, I could go on, but you got to treat this with respect. And if the Fed doesn't do that, like, the data right now is really compelling that the Fed needs to be vigilant, that there is a scenario of a double dip inflation taking hold. And if that's the case, Mark, our recovery isn't the next year and a half to 2 years. Our recovery is the next 10 years. Like, that's how important this is. So Fed, for the love of God, allow restriction to take place here and continue to be vigilant against the fight of inflation, and do not declare premature victory here, or you will regret it. Your legacy will regret this one. This is not one you mess with kids clubs, not on double dip inflation. It wipes out people's wealth for forever. So I just hope the Fed treats that with the respect they need to. And if they don't, that's why we own gold.
That's why we own gold. That's why we own gold. So, Matt, that was a great presentation. Nothing to add. Anything I say just does it. That was fantastic half hour of content. Let's wrap up. Big week. We're going to be on the halftime report every day this week, breaking it down. Fed meeting on Wednesday. We'll have thoughts on Discord. I have no doubt my brother will pump out some thoughts after Pal speaks on Wednesday. Obviously, Matt, you and I will be on the halftime report on Thursday after the Fed talk about it. And then, of course, on the podcast next week. The old world is dying. Now's the time of monsters. I love that. That freaking is the greatest currency quote ever.
Yeah. Gold and Bitcoin.
Yeah. So, send us out, Matt.
Sometimes these inflationary conversations get a little heavy. Because they're important topics, and nobody likes to deal with inflation. Hopefully the Fed can stay vigilant on the battle against inflation. It's not over yet, and if they declare victory against that, it's going to be over for consumers. So I do believe these are very, very important meetings over the next couple Fed meetings. So we'll be breaking it down at Tackle Trading in our halftime report. I'm sure we'll be covering it next week in the podcast as well. Hopefully, sometimes when I have this conversation, I always feel like I never bring it to a proper conclusion, because I always feel like I have more to say and more to say and more to say. And so I hope my thoughts came out in a concise manner and not just spewing up negativity towards the environment. But hopefully it did help you understand the current environment and the importance of this Fed meeting and the importance of being vigilant against inflation. Remember this, though. One last thought on this. There's a quote from Warren Buffett, and he says, and I'm paraphrasing, but he says, there's a lot that can happen out there. All kinds of things can happen. You can have recessions, you could have the death of currency, you could have inflation, you can have all these horrible things happen. But if you have knowledge, then you have a tremendous asset. In every single environment that has ever been, that has been known to man, from a monetary currency, investor, asset-related purpose, regardless of inflation or not, knowledge is the tiebreaker in all things. We do not control what the central bank will do on Wednesday. We do not control what the Treasury Department will do Monday through Friday. We do not control what the president is going to do from a budgetary perspective. We do not control Congress. We do not control any of the policy, monetary or fiscal that have an impact on our lives. The only thing we can do is vote. That's it. That's the only thing we can do in that specific thing. But there's a tremendous amount we can do to separate ourselves from the balance sheet of the United States government. And that's what this conversation is really about, is separating yourself from the balance sheet of the United States government, because your personal balance sheet does not have to look like the United States. Your impact on inflation does not have to be the same as your neighbors. These conversations do not impact everybody simultaneously equal. And it is not money that separates the haves versus the have-nots in this conversation. It's not money and what you have before these conversations that separates the haves and the have-nots. It's knowledge. Because what inflation does, even to the rich, is it wipes out wealth to the point where you can wipe out all wealth. Numerous examples of the last 100 years have done that. Weimar Republic being one of them. Obviously, 1970s double dip inflation in the U.S. You have China in the 1950s. You have Brazil in the 1990s. You have Zimbabwe in the 2000s. I can go on and on and on. The only difference between all of those examples and the United States is one thing, and that is because we are the reserve currency and we export our inflation to the rest of the world. If we lose that benefit, and we deal with the double dip inflation in the U.S. simultaneously while money also comes home to the U.S., you have scenarios that set forth hyperinflation in the U.S. for the first time in our history. In our history. Are those likely? Maybe not. But if they're even part of the conversation, knowledge is the tiebreaker there. And so don't allow these negative conversations of inflation and the impact the inflation can have on people stop you from doing the things that you need to do. And that is to gain the knowledge necessary to withstand these environments. And I say this all the time, but from the dawn of mankind until today, the number one asset that has protected people, wealth, everything they've earned throughout their life has been land, gold, i.e. ground, gold and ground. Land and gold are the two that protect against these one-to-one. Now, is Bitcoin another one? Probably. So let's add that to the inflationary protection asset playbook. But the simple reality is, much like Buffett said, knowledge is the tiebreaker, so acquire knowledge. That's the importance of this. So I hope it came across the way I was intending it to. But with that said, I hope everybody has a wonderful, wonderful rest of their week. And if you need anything from us at Trading Justice, a podcast sponsored by TackleTrading.com, you can always head over to Tackle Trading and get a free trial membership and Tackle Trading, the Pro membership. And outside of that, I hope everybody has a wonderful, wonderful week.
Have a great week, everyone.